A few people have asked me as of late about raising money and how that works. Like, what is the difference between a syndication and a fund, that syndication model or a fund model? So, the biggest distinction between that, and I'm gonna do exactly what people say don't do, man. Don't go deep, keep it simple. I'm good at making things simple, even though they're complicated. So, stick with me on this. So, I'll show you because I wrote it here. Hold on. I'm gonna do this because they're all basically the same thing. When you're raising money, you can syndicate a deal, also known in real estate as a syndication, or you can use what's called a fund model. Syndication or fund. So I'm just gonna keep it simple. Typically, in a syndication, you still got to do all your filings. I'll go over all that stuff, different regulations. You need your SEC attorney to develop certain paperwork. But in a syndication, there's typically a deal already. In a fund model, there's typically not a deal yet, but you have a business plan. So, for example, we use a fund model. I'll go through why that is and the differences of it, why I personally like the fund model better versus the syndication model, because you can toggle between the two, but technically they're both the same. Ultimately, what that is you're getting investors. It is a pool of money all going towards a deal or multiple real estate deals. That's it. I just simplified a lot of stuff for you guys because a lot of people will take a look and go, and you can get as complicated as you want with this because this is a very sophisticated activity. This is real. Like you can literally run over someone in a crosswalk, get convicted of manslaughter, and do less time in prison than if you actually raise money through syndication and funding through Regulation D or A or what different type of regulations that the SEC requires you to file as a company to take in money from retail investors into institutional investors, whatever. If you mess over people's money, you will go to prison. Period. So this is not just, ooh, I'm going to go do a deal. I've never done one before, but I'm going to do a syndication or start a fund. You need to, one, do your homework. Two, you need to take this very, very seriously, which is why I wanted to go over this. So, but to answer anybody's question, a syndication or a fund allows you to create a business, a vehicle that allows you to get multiple investors, 10, 100, however many, depending on the size of your deal, and put their money together. It is considered a security, period. If people give you money and they don't have the opportunity to dictate or decide how their returns are being done, it is out of their hands. It's up to you. You are the decision maker. It is a sin. It is a security. You can go to jail. You do need a securities attorney. Let me tell you how important that is, right? And if you need a good securities attorney, leave it in the comments there, and I'll let you know mine. It's Nate Dotson over at Crowdfunding Lawyers. But anyways, him and Richard Robinette, great guys. They've been my attorney for a long time. So, anyways, the reason why this is important, and people have asked me because they're like, I want to raise money. And I'm like, well, you can get a partner. There's a bunch of different ways to do it. But if you're going to go this route, you need to take it serious. So I wanted to simplify that as to also the way the investors work. All right. So you hear me talk about it. A lot of people talk about it online, offline. You can take money from different types of investors. There's an accredited investor, meaning that person makes $200,000 or more last year, and they are going to make it again next year, right? Or they have a household income, their husband and wife, or however that mix up is, with $300,000 or more. All right. That's one way. That's an income basis. And then the other way is they have $1 million in net worth, excluding their primary residence, stocks, other real estate, other investments, other vehicles, the business that they run, whatever that is. But they have a net worth of $1 million, right? Non-income related now. So then there is the non-accredited people, which unfortunately I think it's a giant form of discrimination because it's an arbitrary made-up number of $200,000 that you need to make $200,000 or you are considered non-accredited. That means if you make $199,900.99, whatever that works out to be, whatever my math is, you don't qualify to invest in some of the best opportunities that you really need because people who need these opportunities are excluded from them when they don't hit this requirement, which is established by the SEC, the government, all the other bureaucracies that come along that say we're protecting the little guy. They actually keep you out of the thing that you need the most, so you are no longer a little guy. But that's what happens when you're not accredited. All right. So if you're non-accredited, you make less than 200,000 a year in income, or you have less than $1 million net worth. If you are above there, that means you are an accredited investor. You make 200,000 or more, you have a $300,000 or more income with a combined household, right? Your house, or you have $1 million of net worth with investments, whatever it is that you do, your businesses, excluding your primary residence. That's why you hear me say you're single family house guys. I bought a house. Well, it's not an investment. If you live in it and you're going to be like, hey, I'm going to live in here. That's my nest egg. That's what I'm going to do. The SEC doesn't even put that on your balance sheet. They consider that a liability. So here's why that's important. Because if you're going to raise money using a syndication or a fund, there's different filings. There's rules, right? Or a Reg D filing. But it's a 506C. That's what we have. We have a 506C, meaning that it's an accredited only fund. You got to make 200,000 a year plus, or you got to have $1 million net worth. That's the only people who can invest with me. If you don't do that, if you're non-accredited, meaning you make less than 200,000 a year, or you have less than $1 million of net worth, then you can't invest in my fund yet. I'm going to do something as it relates to that. There's other regulations we're working on that. But there's another way that you can raise money if you're going to syndicate or you're going to have a fund. You can do a 506B as a regulator. The filing is that's what it's concerned. So you can have non-accredited investors, right? I'm going to push these back so you can see the whole thing. You can have non-accredited investors in there. You can have unlimited accredited investors, and I think up to 35 non-accredited investors. A lot of people do the 506B. Here's the difference. In the 506C, I can general solicit. I can come on YouTube. I can go to Facebook, Instagram, LinkedIn. I can speak on stage. I can get a billboard. I can run ads. I'm sure you guys see them everywhere. And it says, hey, invest with us, accredited only. That's called general solicitation. You can general solicit with a 506C as you're raising money for your syndication or your fund, but they have to be accredited, meaning they got to make money. Basically, they got to understand investing. We all understand investing, right? No matter how much money you make, if you're following anything, that information is now free to figure out. All right. But if you have a 506B, you cannot general solicit. It has to be you have to know the people. You have to have they call it this three-touch thing that they have now. Is like you have to have a pre-existing relationship, but the pre-existing relationship is very gray. What does that even mean? To me, it means I have to know your financial, not physical. I got to know your financial situation. Towards if you were to invest at some point, will this financially hurt you? Will it hurt your family if you invested a certain amount of money? There's another thing that people talk about. They rarely talk about it, but it is a rule of thumb. It's kind of some attorney is going to probably hammer me about it, but it's the 10%. So let's say you only make 100,000 a year. Technically, the right thing to do based on the rule of thumb for a non-accredited investor should only allow you to invest $10,000 if you only make $100,000 a year. But let's say you're non-accredited, but you have a business and your business, however you run your business, you make a lot of money in your business, but your personal revenue and you don't have your business structured the right way, you may still be, looked upon as non-accredited. Then it's relative because somebody asks like, hey, if I inherited $1 million from someone and that I have this money coming in every month as monthly payments, whatever, right? They can still be non-accredited and have access to $1 million and still not qualify as an accredited investor to be an investment 506C, which I personally think is bullshit, right? I know doctors who make a lot of money who hit this 506, who hit the accredited, but they aren't great investors. They're not good business people. They don't have that. So that's why I said it's kind of discriminatory because it's not a color thing, it's not a race thing, it's not where you live thing. It's just like, dude, that's crazy. If you know what you're talking about, you should be able to invest, right? With the right disclosures, knowing the risk, doing your own research. That falls within the lines of what a sophisticated investor is. Sophisticated to me kind of falls along different things. That means you've done the seminars or you've done some investing on your own. Let's say you're like my kids. My kids would be considered sophisticated investors because they're not old enough. They don't have a huge income or nothing, but they've been around real estate, investing, sales, money. They understand money. They understand those things. They've heard it enough to say, okay, I can make a decision. And, if I get hurt, I knew what I was getting into. There's another way to do this too. I think you can take your Series 63, Series 6, Series 6, one of the series licensing to get your financial advisor license and become a financial advisor or an investment planner or one of those type deals. That allows you to become accredited. But why go through that? Take the test. You're going to have to hang a license somewhere and you got to get the job. That's the other piece. And then I think I read someplace the other day was like the other ways you can start your own RIA, but you got to really want to start a business in there just so you can invest. So the fastest way to become accredited to me is to start investing. Whether you start small investing, whether you buy your own deals, buy your own properties, invest in the stock market, invest in your own business, and start raising your income to hit this target, and then you can invest in a 506c, which is the better deals, right? Deals like mine's, deals that are out there. Now, other people that have great investments, they do have great investments with the 506b. They start there. They're like, hey, I'm just going to go to my network. They go, they talk to everybody, they do seminars, they talk. Eventually, there's a pre existing relationship. And then those people who don't make enough money can still invest over time, right? So that's a way to do that. I personally did the 506c because even though I have a decent sized network online, I want to continue to talk about my investment opportunity, which goes right back into what I'm gonna start talking about as I talk about the difference between a fund and a syndication, right? The fund model allows me, the way that I structured mine, I can raise capital, I can raise money from investors, I can talk to investors, I can put out investor campaigns, I can solicit, meaning market all over the place, and I can get to know people. So technically, I'm doing the same thing that somebody with a 506b would have had to do. I make videos, I post, I write books, I do seminars, I got my networking event, we have our meetup groups, we do calls every week. I'm still building a relationship with my investors as we're sourcing opportunities and deals to present. So no one's going to get around this. Whether you market and people meet you, they still got to get to know you. They got to know you, like you, trust you, see the deals you like, know their temperament for investments and risk, because there's a giant risk and you can lose all your money investing in a deal with someone else. That's just the truth. But it doesn't matter where you fall in the category, you still got to do this. So I chose the fund route as the fund FUND route as a business strategy because Bell Capital is a real estate fund. It's a private equity real estate fund, and we will continue to raise money and close deals with our investors for as long as I'm alive, and then it's going to continue on going because we're doing it as a company. Typically, 506Bs, they are not doing it as a company. They're typically doing it as a syndicator. You don't have a lot of 506B people or that start a company that way. And when they do, it's on an individual basis. It continues to grow, and eventually they have to scale because they can only meet so many amounts of people before they have to go, look, we got to do a C and we got to do some marketing. All right. I wrote this that way because I wanted to go over a couple things. I already went over what a syndication is, what a fund is. The fund, they're models. Syndication is pooling money with investors. A fund is pooling money for investors. Here's a little bit of the difference. Pros and cons. Some pros and cons of the fund and the syndication. All right. I'm gonna pull this back some. So in a fund, typically with the fund model, and we're talking about it's called a blind raise. I'll write that down. Blind raise. Usually funds start off like that. If you see Blackstone, they start their own funds. BlackRock starts a fund. Starwood Capital starts a fund. Equity Residential, they start funds. All of the big players on the planet, these big institutional companies, wealthy institutions, they have funds. They start a fund, they go, they raise a bunch of money based on the plan, and then they go and they execute that plan on the specific real estate that they're looking to buy based on what they told their investors who are committing that money. So I personally think, for me, other people say, I mean, now it is harder to do a fund, a blind raise in a fund. I'll be the first person to tell you it is a lot of work to do that. So if you want to start your own fund, just know that you need a network. That is number one. You need a plan. You need great deals. You need access to people. If you are a syndicator, typically syndicators already have found the deal. They've already found the deal. So in a fund, is there a deal? In a syndication, there's typically a deal. A lot of times in a fund, there's not. Now, you can find a deal with a fund and you still structure it like a fund and you raise money over time. But typically on a blind raise on a fund, on a private equity fund like what we have, there's no deal. But in a syndication, there is one. That's a plus for the syndication, but a downside for a fund, right? Is there a plan? Yes, there is. In a syndication, Yes, there is a plan, but this plan can change. Why? Because let's say they syndicate the money for a deal, they get into the deal with the plan, and the deal dictates their plan. So now they're like, okay, fine. We said we were gonna do a value add plan. We're gonna put $10,000 per unit in a deal for 100 units. All right, so we already know where we're at. But they go inside, they do their first, they close the deal, they do their due diligence, they have a budget of 10,000. Along the way, lumber cost goes up, right? Um, labor cost goes up, insurance goes up. Their plan changes because now they have this plan that they had, but their plan is not as flexible. Maybe they've underwrote it, basically saying that, yeah, this is going to be our cost. But along the way of syndicating, because they get the deal first and then they get hit in the face, as opposed to us, hey, we may not have a deal, but we have our plan. We're sticking to our plan. So we will wait to get the right plan. We can watch and we can look at what's going on in the market and we can adjust our plan accordingly and inform our investors. Hey, guys, look, we were looking for 150 units. The market tanked. We're now looking at 200 to 250 units, but the way that we were structuring returns has changed. The way that we were structuring the type of deals, like we were initially looking for light value add deals, meaning like light renovation cost. That changed as the interest rates changed. Because as the interest rates went up, pricing got stable and also some of the values came down. So we're like, hey, we can get nicer properties without needing to do the value add plan anymore. So our value add strategy that we were looking at first, the light value add, we didn't want to do a lot of work, went away. Now we're like, hey, let's just get something with no work. So we'll be able to get better returns with less risk for our investors. They can't do that. That's why you have a lot of syndicators right now that went belly up recently. You have Tides Equities, they went belly up on their value add plan. There were some other companies out of Houston that bought a bunch of real estate over there. They syndicated a bunch of deals. They came in with a plan. Their plan did not get executed. The interest rates went up. Their plans went south. Then they went belly up because they had this plan. They had the deal first and they got locked in. Their investors had no way to get out. And now those deals actually either went back to the bank or they've sold them at a discount because they came in and syndicated the deal first and the door shut on. All right, so next, access. Do you have access to the team? Yes, you do. You have access to a team here, right? So the fund managers, we always have access to a team. We got access to our brokers. We got access to our brokers teams. We got access to their debt teams. We got access to our own teams because we have time to build a team based on our plan that doesn't change because we're building the business off of the plan of the real estate, not letting the real estate dictate our plan as we go. That's how we have access to the team. You may not have access to a great team in a syndication. They may come in with one team, fire them, get another one. Oh, this management company knows how to deal with value add. Now that we've completed our value add plan, we got to get rid of this management company because they still overcharge. They don't know how to deal with these specific tenants. They like things change. So you may not have access to the same team the whole time. In a fund, a blind raise, you're building a company, which is what we're doing. We're building a company with the team, right? So there's the difference. I get to execute a plan and I get to build access to a better team of people along the way because we get to build the relationships with our plan. This isn't always going to happen. This may change. Next, are there fees? Yes, there's acquisition fees, there's asset management fees, and there's also disposition fees. Same here. There's acquisition fee, there's an asset management fee while they're doing what they're doing, and then there's also a disposition fee. So there's fees on both sides here. Now, we talk about access to a team. Over on this side, we talk about the team itself. So as an investor, do you have access? There's a fund. When you're building a fund or you're using a fund model for a business structure, you build a team around it and you have access to your team and other people's teams. In this one, they tend to start a syndication and they're relying on building the team after they get the deal. If they aren't starting it, if they don't have the team first, what will happen is they'll go and they'll get other syndicators to put in. It's called like a fund of funds or a co-GP or a co-general partner. So they'll be like, hey, we're raising money. We have this deal. If you guys can put together $500,000, we'll let you co-GP and you can be a part of our team. You may not know who that team really is. So they do have a team, but it may not be the right team. This is what happens when sometimes you're letting your deal dictate where you're at. Because let's say, like we said, you have a co-GP, they raise 500,000, you have 10, let's say 10 groups of people raised $500,000 and need to raise $5 million on the deal, right? So now they're there. Those 10 people own 20%, right? So each one of those 10 people in one co-GP are inside of a 20% ownership because it's an 80-20 split or a 70-30 split. So the GPs own 30% of the deal. All right. So now you might have, let's say, that group of 10 in five, that's 50 people that own 20% of the deal. So when something goes sideways, you have all these people who are bragging about we're on the team, we're good, look at our backgrounds, look at our experiences, but they may not even know each other. The right hand may not even be feeding the right hand may not be feeding the left hand. So you don't really get access to this team in a fund or like in a fund model. The team is the team. You meet them, you know who they are, you get to see them. They're talking about what they need to talk about. There's not a whole bunch of different people. They do fund to funds and co-GPs in a blind raise. They do. But typically there's one person in charge or a small group of people in charge, and that group stays very close knit, and they'll start another fund after they close another deal. They'll raise money like that, and it's the same team. They'll expand the team and grow the team, but it isn't a diluted team all the time. So you don't have to go with the back and forth, which is why you go in one syndication and it's one team. You do another syndication with somebody else, and it feels like you're working with the same group. Oh, no, that's a different one. We don't have them on their stuff. We didn't like them. We didn't do that. Blah, blah, blah. This person had a lawsuit. That happens all the time. Debt, yes, on both of these things. Typically, there's debt on both. On a blind, like we get the debt. Our investors don't get the debt. So in a fund model, yes, there is structuring of the debt. In a syndication model, yes, there is structuring of the debt. This can change on the syndication side. Like right now, a lot of these people's debt is up. They had a short-term turnaround. Typically in a syndication, they're short. They're 3 to 5 years because their plan is to get in, find a deal that they need to do a value add play on, and then fix it up, and then refinance that property, and then do whatever they're going to do. So unfortunately, because it's shorter term debt, it's like this on bigger funds too. When they're dealing with institutional capital, they don't go to long debt. They usually can't go past 5 years if they're dealing with an institution like CalPERS, a life insurance company or something like that, that their partners, MetLife, National, New York Life. So, and I'm going through this about the debt. The debt's typically short term. On a fund, on my fund is 7 to 10 years. I can do 10-year debt because we're the GP. I'm the GP on this deal. For Bell Capital, we're the 20%, and our investors are the 80%. So I can go longer on the debt. Typically in a syndication, they're going to turn short term on the debt, which is where things bad happen. I go long term on our debt structure, which is why I said the plan, because if I need to stay in that deal longer because the market shut, think about what happened from 2019 to 2020. The market shifted, the interest rates went up. If you had a 3% interest rate and your interest rate went up to just six, right? That's 3%. That's for every 1% on a 3% interest rate, that's 30% increase in your debt service, right? Meaning like your payments, like your annual payments. That's a lot. That's like, almost a 90 or 85 to 90% increase in your debt service over the year. And if you did that and your window is shutting, like, hey, we got to refinance right now, and you can't, your syndication model based on the debt is locked. For me, I can be like, hey, look, let's go 7 years on this thing. I don't want to go five. We got a good deal. We can get the good debt. I can lock that up. We've already discussed this with our investors. They know that. And oh, by the way, because I'm the person signing on the loan and I don't want to sell a good deal at the worst time ever, I can actually extend the timeline. I can go back in and get more debt and keep us in the deal. You as a syndicator typically cannot do that, right? So the syndications have a little bit more risk because they're deal specific, which means they're timeline specific, and that also means they're debt specific. And last but not least, your investor network. Your investor network typically in a fund is much better because there's a lot of people in a fund, right? There may be 100 people on a deal. In a syndication, there's not going to be that much. Yes, there are great syndicators out there. I mean, one deal in a fund is technically still a syndication because you can have 3 or 4 deals or 2 deals in one fund, and then they start raising more money because it's really the pool of capital that is the source. But you're going to have a very similar type of investor in a fund, right? Multiple funds. You have fund two, like we're on fund one. Later, we're going to be in fund two, all the way up to fund 20. But your investors are probably going to be the same. In a syndication, it could be anybody. You don't know. Because, like I said, you can have a accredited, you can have a non-accredited. Right now in mine, it's accredited only. Later, even if I did a non-accredited, they'll partner. We'll have a fund for the not for accredited, and then we'll have a Reg D, a Reg A fund, which is accredited and non-accredited, but we're going to let them ride together. Two separate funds by one asset, right? On this one, no telling what you're going to get. If you have a 506B, you can have accredited, non-accredited, and trust me, it'll be people arguing with each other. Well, I only have 5 grand in there, and somebody else that has 5 grand in there, somebody else in there may have 200 grand in there, and the person with the 5 grand is complaining. And even though they're riding on the back of somebody that has more money, more assets, and it's a benefit to them. But if something goes wrong with the deal on the syndication side, and it's the only deal, then that's a problem, right? So it's going to be an issue. So your investor network inside of the actual business itself, your investor pool, you as a fund manager or syndicator, or you as an investor riding in that network. I mean, and I'm sure you guys have seen the nightmares. Sometimes people are in a syndication and they get together, the deal goes sideways, and the investors, man, they start to bicker with each other. They start to fight. But usually in a fund, you don't see that as much. So even though I talked about like the difference between a syndication and a fund back here, and the basic overview of that is it's all a pool of money, all dedicated to go and buy a deal. So that way the investors get opportunity for returns, and the syndicator and or the fund manager puts the deal together, and then they all work together. The syndicator or the fund manager actually operates the deal. They're considered the operator. And then the investors are passive investors or limited partners, and they get a return based on there. But there needs to be filings. You got to do this legally. You got to go with your SEC attorney. There needs to be that. Oh, I guess I can talk about this. Usually in this situation, here's what you're going to get. If you're going to invest in a fund or a syndication, this is some of the documents you need to be looking for. You need to be looking for a private placement memorandum, a PPM, which is a private placement memorandum. There's going to be an operating agreement. All right, I guess I'll write that all out. There's going to be a subscription agreement. That's important because this is how you get started. You do your subscription agreement. It basically says, I'm an investor, I'm accredited, and I'm going to invest $200,000 or $300,000 in this deal. And then you're going to put how much you're going to do, and then you're going to sign your subscription agreement. That subscription agreement basically is saying you agree that you're accredited. That is a must. You got to prove that. You're going to check the box whether you're investing as an individual, an LLC, a trust, if that's possible for the investor or for who the syndicator is. It is for us. We'll do if you have your own LLC, your business, a trust, a family type trust, things like that. A SEP, an IRA, 401k, however it is that you're doing, you're going to put the entity that the money is going to be investing in. Then we have our other thing that says it's a bad actors form, right? So inside, this is all inside of your subscription agreement. Basically, if you're an investor and you're going to be 20%, you're going to invest 20% of that. So let's say on a $50 million fund, you're going to be investing $10 million, right? Like you have to sign what's called a bad actors form, meaning like you've never done anything federally wrong, you haven't stolen money or have some tax problem, you don't have a bunch of legal judgments, you aren't gonna be like a pain in the ass later because you have 20% stake in the actual overall 80% because of the amount of money, right? And typically I tell people you don't want to do that anyways. Once you start getting up to a certain over percentage of being a main person, sometimes lenders look at you, right? So and also in there, like I know for one of ours, it's like for what is it called? Like when you're married, like the common assets. Like whether if something were to happen to you, you want them to go to your wife, or if something were to happen to your wife, things are going, or she's not going to be a part of it anyways, right? You're going to do it yourself, but none of this stuff has anything to do with your spouse. Like we have that document in there as well. So you should be getting all this document. You should get your any type of tax document, right? Which is the basically is how you receive your K1 from there. And then on the other one, there is a accreditation letter. Accreditation. You get it. The accreditation letter. That needs to be signed off by your I know I screwed that all up. That needs to be hacked off by your your CPA or your accountant. Basically, it's a letter that says, yes, you're accredited, either you make 200,000 a year, like I mentioned before, or you have $1 million net worth based on assets, and they are signing off on that, saying that that's true. as well as for us, we always want to verify that. We use a third-party verification, or we do our own verification and qualification where we will contact your whoever gave us that document and do our own follow-up. But typically, we're going to use a third party to verify your accreditation, right? Um, Things like that. All this information is typically held inside of an investor portal. If you want to take a look at ours, go to bell-capital.com. You can hit get started and you'll fill out the form. Yes, I'm accredited. You do your name, your email address, your phone number, and it'll take you inside the investor portal that we created for you. And you can take a look at our business plan, the types of deals we're going after, why we're going after those deals, why now is the opportunity. And you can take a look at all of the documents themselves, the private placement memorandum, which says how much the investments are, the splits, the source of use for the money that we raise, what our fees are, the timeline, the 7 to 10 year hold, my opportunity to continue on and press that timeline if something's not doing well, or we can sell quicker. All of that matters. The operating agreement, like who does what my responsibilities are as an investor, or I mean as the general partner, what your responsibilities are, as well as, like I said, the subscription agreements, the tax forms, your accreditation letter, that all of this stuff has our company Bell Capital business plan for that specific vehicle and fund, registered with the SEC. We're in good standing and needs to be registered with the state, as well as with the SEC, with our filings that are done by an SEC attorney, which are crowdfunding lawyers, which is our attorneys. So I know this was a lot, but the big picture here is the difference between the syndication and the fund as it relates to, for me, the blind race, which a lot of people are like, which one's harder? Well, naturally, the blind race is harder. You got to go meet people, talk to people, express your business plan, make sure they're qualified. There's a high level of trust. And then it also is a high level of follow-up too, because every time I do a deal, I'm like, hey guys, let me show you the deals that we're underwriting. Let me show you the deal, why we liked it, why we made an offer on it, why we didn't get the offer, where we came out in our underwriting, deals lost, deals won, where we are. And also keeping up with the market, the interest rates, what's going on in the market, what's going on with taxes, what's going on with the cost segregation, depreciation, the election, how that affects real estate, everything across the board. That's why you always see me grinding, going to seminars, going to events, talking to industry leaders. This is important, right? All of this has to do because this, guys, this is a business. Being a fund manager, an equity fund manager, a private equity fund manager means that we raise equity. We don't raise the debt. We get the debt on the assets, right? That's different. There's people who just have a debt fund where they only raise money for debt. There's people who raise money just for equity. We are equity. So, there's a lot of work to this. This is a business. This isn't just we're raising money for a deal, right? You are doing deals because the deals are the things that pays the investors their returns. But as it relates to the operations, what needs to happen, the filings, making sure everybody's done, making sure we're legally compliant based on SEC requirements, state requirements, the federal requirements, legal, everything. It is so much work, but I do it because I want to help the everyday investor get invested in these type of deals. And this is how you do it. The problem is they don't go over all this stuff with a lot of people, right? I'm here for you. We are here for you. We want to be a resource, one, for you to be able to invest in real estate. Two, we want to be a resource to answer any questions that you have to help you get invested in real estate with us or on your own. But the goal here is so that way you are educated in what you're doing, why you're doing it, and also why we're doing it. So that way you can make the right choice for you and your family to make an investment. All right. So the difference between syndication and a fund, they're both about raising money. One has a deal. Syndicators have a deal already. Fund managers are raising money for a general area, general type of deal. And that's what they're raising the money for. That is the main part. There's pluses, pros and cons for both, right? I think personally, being a fund manager doing a fund is better, regardless of whether it's harder, regardless of whether it's a blind raise, regardless of whether people want to see more stuff. Good. I want you to be skeptical. I want you to see more stuff. I want you to see the deals first. I want you to like what we're doing and the business plan and the model that we're doing it with, rather than push you into a deal because I have this I'm under pressure because I got to close. Hey, do you want this deal? Good, let's do it. Like that day comes, but it doesn't come if you're not under the pressure of constantly having to syndicate a deal. Unless you have a track record, you syndicate deals. But even those guys are using the fund model because they're out talking to investors all the time. They built a big pool of investors. So when they show a deal, they're syndicating that deal. And I may do the same thing. The deal we get for our fund may be a one deal fund, but we're going to raise all that money and it's still a fund model because of a lot of time, the amount of time that we dedicated to building a relationship with our investors. I can raise money all year. Syndicators don't raise money all year. They raise money for a deal, they close, and they're done. And then it's a transaction. I can raise money all year, build my investor pool, and get more people interested in what we're doing. And they can do their commitments on money. And then we don't have the pressure. We're not going to make mistakes because we set it up differently. I don't like risk. I'm extremely conservative. I do not want to lose money. So I don't want a noose around my neck, just like you don't want one around yours. All right. So I hope this helps you guys. For those wondering the difference between a syndication and a fund, the pros and cons of each, a blind raise on a private equity fund, or a syndication with a deal sitting there. What are the pros and the cons? And if you're taking a look at, now I went through the 506B, 506C, 506C, I can go out to the market. 506B, I cannot general solicit. I got to only talk to people I know and build them up over time and have a pre-existing relationship, whatever that is. A lot of dinners, a lot of meetings, a lot of knowings. And then also, if you're going to do a private placement, or if you're going to do a syndication, or you're going to be investing in a fund, these are all some of the basic things you should get outside of just being able to see the deals, know the deals, talk to the people, talk to the team, know what the business plan is, and are they even sticking to the business plan? And these are the documents you can expect to see, so you can actually do your own due diligence, do your own research, talk to your accountants, talk to your planners, and find out whether this is a good thing for you. All right, you and your family. So I hope this helps. This is a lot. I know I went through a lot. I don't go through this much. I don't get this deep into a scenario, but I wanted to do this because people were asking me about that. What's the difference between a fund and a syndication? And what does that even look like? Which one's better? And if you were going to do it yourself, what you need to look forward to or not? Or if you're going to invest with somebody like me who has a fund, or you're going to invest with a syndicator, what's the difference, right? So I hope that helps. Let me know if you need anything. Like this video, share the video, comment on the video, give it a thumbs up. If you hated it, give it a thumbs down. Don't be a hater and a hider at the same time. Man, I'll take them both. But leave me a comment. What did you take away from this? What did you learn? If you're syndicating a deal, am I right to you? If you're not syndicating a deal, you're looking to raise money, you're looking to get into real estate, and you want to either do a fund because you want to be this a long-term business for you. You want to do a syndication where you just want to raise money on a deal-by-deal basis and do that. Like, what can you use from this that you got? I would really love to hear it. All right. So have a great day today. I appreciate you. Let's go. Boom. Are you an accredited investor with $300,000 or more liquid in the bank? I want you to come and partner with me. Look, if you love real estate, passive income, and positive cash flow, appreciation over long periods of time, and you're willing to be patient, come invest with me. Go to bell-capital.com. This is for accredited investors with $300,000 or more in the bank, ready to go. Come invest with me. Go to bell-capital.com.